Welcome, everyone. This is The Money Path. I'm Janet Alvarez. This is our inaugural show. We're thrilled to have you on this blockbuster earnings day with big news out of retailers like Best Buy sending their stock up 15% today. We'll also take a look at NVIDIA, what the Fed is likely to do next, the trajectory for the economy, and more. On today's inaugural show, we have the pleasure of being joined by Jeff Macke. Yes, that Jeff Macke. He's founding partner at Wall Street Beat. Jeff, how's it going?
It's going super, actually. Not as bad as some of would have predicted, and sometimes that's good enough. Like you say, we've saw decent earnings out of Best Buy. That's moving a little bit. God is in his heaven, and all is right in the world.
So all of the retailers, in my opinion, have been surprising positively, with the exception of Dollar General, and we'll talk about them a little bit later. But the mainstream retailers, the Targets of the world, the Best Buys, as we're seeing today, are all doing well. We saw retail sales also a week or two ago come out hotter than anticipated. Why is the consumer still faring so well? Is it a simple people are employed equation? Is there still any leftover stimulus money in their savings account? Why is the consumer
Yeah,
still so
best damn consumers in the world for one reason, USA. But honestly, expectations were low. And so what we're seeing isn't necessarily better than expected on for the great retailers. We're going straight into kind of the Lululemon high-end type of stuff later on tonight. But for promotional companies like Gap, even Abercrombie, where the stock got poleaxed, but that was more a function of the stock, those numbers look like a misprint. They reported 18% comp store sales, and it's like, yeah, I mean, it's you can sell the stock all you want, but that's an incredible number. And it doesn't happen unless the consumer is just a little better than people think. And so there's always this spread, Janet, between what people tell pollsters and how they actually behave. And how they're actually behaving is they're buying some stuff carefully. They're buying stuff like a public that feels as though maybe rates are going a little bit lower and they can wait for the super big stuff. But in the meantime, let's freshen up the couch. Let's buy ourselves, in the case of Best Buy, a nice new flat panel TV. I've actually been in the stores fairly recently and kind of was fortunate enough to get in front of the trade today. And it wasn't the idea that Best Buy was going to be doing great, because they're not doing objectively great, but the trajectory downward has kind of flattened out a little bit. And so with every good reason in the world to pause, the consumer isn't really pausing. They're actually spending a little bit, and that's kind of good enough in a trading environment that's looking for new ideas.
One of the ideas that I've heard discussed quite often over the past year or two is that, yes, we've had this inflation difficulty to deal with, but we've also had record wage gains over the past couple of years. So to the extent that you have a job, have kept a job, you've also seen your wages keep a pace of inflation. And now you have retailers that are starting to demonstrate a little bit more price elasticity. People are enjoying those wage gains. Even if they're not super confident about the economy, they still have a little bit more money in their pocket than perhaps they anticipated.
They've got enough. People find a way to buy stuff in all the real crisis situations. And so it's natural after coming out of COVID, where everyone spruced up their home. I'm a little nostalgic for those days, both as a consumer analyst guy and just, I miss having my kids around all the time. But you spruced up the house. It's natural that we pulled forward a ton of demand during that period, and it's going to take years to kind of wear that off. But it's slowly happening, and the economy is kind of growing in fits and starts. But what we heard from Walmart, that's a company that does between $1.5 and $2 billion every single damn day in America. They are the economy. You can chuck economic statistics at me all day, and if I'm on a desert island and I can only trade economic statistics from the government or what Walmart says, I'm going to take Walmart every time, and I'm going to win, because they're just going to give you a more honest shot. And what they're saying is our discretionary goods, stuff that people don't have to buy, but they do, are picking up just a little bit. You don't need that much, because we laid off it. No one's been doing everything since we reopened the economy. We had plenty of discretionary goods all piled up in our houses, and everyone chose to take a vacation. Well, now you're seeing some of the travel stocks, they're coming down a little bit. Some of that the data that people just traveling, it's going to be the most packed Labor Day in history, but that doesn't mean we're spending top-notch flight rates on either flights or hotel rooms anymore. It just means that we're kind of shifting the view to people getting into more normative habits, and that is kind of good. I mean, it's a healing economy still. It's not as bad as people think, and again, as we said, that's good enough for a lot of these stocks.
So let's talk about this idea of good enough, right? Or the soft landing that everyone has been lauding for so long, because that really looks like what's materializing. So, Jeff, you're a consumer expert, you're a retail expert. Tell us what the historical norm looks like in regards to consumer spending, in regards to the retail space. Where can we anticipate the softening in the coming quarters and the strength?
What you're going to be looking for is first of all, the stocks will lead the actual data. The stocks will get better, and that's what we're really starting to see. We're seeing companies that have underperformed for quite a while on those downward trajectories. It stopped getting worse, and that's in terms of their own internal data. But what you're looking for a tell are companies like Home Depot. They reported not great quarter. Lowe's, those were great numbers. You're in still an inflationary environment, so to be posting low single digit comps, you're losing to inflation. But at the same time, the stocks are stopping. They haven't reacted negatively to this otherwise mediocre news. That's your first sign. That's a canary in the coal mine. If you're someone who likes to kind of track these things, that's an indication that Wall Street at least is betting that stuff is going to get a little bit better, that it's that we're on kind of the front end of that. Now, that some would argue that's anticipating a rate cut. I would argue that that's anticipating economic improvement. The rate cut is almost superfluous in terms of where we're going, which, I'm going to get in trouble for saying it, but maybe we don't need the rate cut. It's the market's going to get it anyway. So Katie bar the door for some of them. But what I'm looking for a real turn are going to be, are people investing in their homes again? Are they investing in stuff for the long haul? Are they expressing their confidence in the form of making expenditures that require a little bit of faith? You can buy a nice T-shirt with some faith. You buy a house if you feel real confident that you're not going to lose your job over the next 20 years, and things are looking up family wise. And we're seeing that build a little bit despite these huge headwinds. There's obviously political turmoil. We've got an axe fight and an election going on. It's candidates that neither party really seems that excited about. There's all kinds of excuses to sell, and yet people aren't. That tells me a lot. That tells me quite a bit about the resiliency of this economy and the consumer in general, and kind of just markets. I mean, this is breaking news. We're at all-time highs. Go figure. It's the fact that no one expects to be here and it's hard to justify. Well, that is also bullish. I mean, it's people want to buy, they want to believe, and barring some huge exogenous shock, I don't see any reason to fight that.
So, it's often difficult to separate economic performance from market performance, and they're really not one and the same. And in a market that so many say has been overbought, has lost breath, has been overly focused on the Magnificent Seven, are we looking towards an increase in breadth now? Are investors starting to view this market more honestly, more openly, more unbiased?
You've seen a rotation in the stocks I look at in NVIDIA. Today was supposed to be Christmas. Today, we're talking on the morning after the NVIDIA report that just companies that don't otherwise pay much attention to these things, we're obsessing over NVIDIA's earnings just like crazy. First of all, if the whole world's looking at a single earnings report, it's going to be really hard for an individual investor to find an edge there. But second of all, that stock reacted not that well, and the market's not crashing. It's NVIDIA pulled back a little bit because they're pricing in reality, which in the case of NVIDIA is an amazing reality. But they didn't knock the cover off the ball. The market stayed fine, and we're still seeing gains in other different sectors. You look at the retail space, Costco and Walmart are making all-time highs. Those companies don't make all-time highs if the world's going to straight hell in a handbasket. A deep recession is not actually good for Walmart, no matter what anyone tells you. It's not great for Costco. These are just really solid companies in a world where we need kind of better ideas. On the other hand, Abercrombie Fitch, you mentioned that already. ELF, these darling stocks with enormous earnings growth. We hear from Lululemon this week. That's another kind of fallen angel. But a lot of these big Mo lighter substance, high multiple companies have kind of fallen off a little bit, and we see it in the Mag 7 as well. Those have calmed down, and yet the market is hanging in there. So absolutely, we're seeing an improvement in breadth. We're seeing more ideas kind of fill the void, and that's great because you know, these YOLO kind of FOMO trades, whether, you know, pick your acronym. If your investment strategy has an acronym, that's probably a sign that you need to come up with a better idea. And what we're seeing now is that breadth is widening out. That's totally healthy, and this is pretty good market action for, you know, a late summer type of year.
Let's talk about Dollar General for just a second. Not because I think they're the most emblematic stock of the retail space, but because I think they represent a particular type of consumer, a particular part of the consumer market, right? And to the extent that we've seen an increase in unemployment, we're at 4.3% or so now. I think the composition of the increase in unemployment is very telling, and it's reflected in stocks like Dollar General. Are you concerned at all about this sort of bifurcation that we're seeing in the economy and in the markets, where stocks, companies that cater to lower income consumers, and frankly, lower income consumers, period, are tending to bear the brunt of any slowdown that we're seeing economically?
I think Dollar General customers can drive 5 miles extra and get to a Walmart where they don't have the problem of rats defecating all over the food that's being sold.
Oh,
I think I'm not making that up. That's a thing that happened at Dollar General. It's a widely reported story. Dollar General disrespected their customers. I don't care what end of the consumer spectrum you're dealing with. You can't disrespect your customers, and Dollar General committed the ultimate sin, which is we're going to build 20,000, 30,000 of these 8,000 square foot stores. They're basically kind of just tin box stores, and we're not going to maintain them. And you know, the new CEO, who's the old CEO, came in vowing to fix that, but that's not their model. Their model was to make it as cheap as possible, and that's coming back to haunt them because you know, it's just really hard if you disrespect your customer and your workers. They've got OSHA violations as well. It, you know, who's left to buy the goods if you know, you've cut back the how many people you're actually paying, and kind of made it as hard as possible to have pride and walk into a store. My dad was a retailer, and he used to say, you know, you got to give people just a little more than they expect. It doesn't matter if you're on the high end, that means kissing their butt a little bit more. If you're on the low end, that means you take a mop out, you make sure the displays are clean, the store is clean, and people are safe shopping there. And that's a win. Dollar General didn't do any of those. I think they're emblematic of a collapsed retailer much more than they are anything having to do with the economy. And I'll put one other thing in there. It's companies that are doing well. They don't complain about weather. They don't complain about the economy. They don't complain about the consumer. They just think things are fine, and they operate in this crazy happy vacuum. And it's companies like Dollar General that say, "Oh, our consumers under pressure." Well, you know what? Maybe get the rats out of your store.
that's a fair point, a very fair point indeed. You know, Jeff, you've taken a little bit of a contrarian stance, and I don't think it's that contrarian because if you'd asked me 6 months ago, I think I personally had the same opinion. You don't think we need a rate cut next month. And there are so many that are arguing, well, you know, even if the economy is still relatively strong and resilient, monetary policy is still too restrictive, given that we've seen a decline in inflation. The real rate is now more restrictive than what the headline rate shows. Why do you disagree with that?
As a stock guy, I'll tell you what, I like my catalyst nice and fuzzy and out there in the future. And that's what a rate cut is. We're going to cut rates, you know, it's someday, and we'll do probably more than one cut. We'll do a couple, maybe. You know, it's Jay Powell comes out and says the same thing over and over again, which is we're going to be data dependent. I'm not sure how many different ways he's dressed that up, but you know, the age of great Alan Greenspan kind of being the transparent Fed chair to what we have now, which are these endless press conferences where it all comes down to we're going to look at the data and then we're going to argue about it and then we're going to decide on a rate cut policy, has rendered the Fed a little bit like the NVIDIA earnings report of economic policy, where the whole entire planet's looking at it. And it really says more about what we're interested in than what Powell's doing himself. I'm not sure the rate cut itself, it's a little bit of a MacGuffin in the sense it's a film term, it's a plot device. It's what drives the story forward. In terms of how much we need it, you can point out strains. It would be great for the housing market. There's a lot of different sectors. We talked about Home Depot before. Boy, yeah, they would want to take the other side of my entire take on this doesn't really matter. They're begging for a rate cut because that'll get people to buy homes. But right now, people are behaving as though that's imminent, and that's kind of good enough to get us where we need to go. And so clearly we don't need one. The stock market's at all-time high. Unemployment isn't that bad. Things are kind of going okay. There seems like a don't mess with it economy on the surface of it. That's your counter argument. The other side of it is, man, you can't tease this stuff for eternity and expect the market to keep showing up, and so it's time to kind of loosen the reins.
The question too, I have to think, Jeff, is just how inflationary it might be, right? If we're seeing retail sales figures coming in stronger than anticipated, if we're still seeing a very strong consumer, strong forward guidance from all of these retailers, what will it mean when we start getting even modest rate cuts in the face of that sort of consumer strength?
Yeah, the inflation has been really sort of it's limited, at least in terms of the areas it's affecting. And if you're trying to get insurance in California, where I live, holy cow, does it seem inflationary? As a political argument, the idea that Kroger's is price gouging is just kind of lunacy. So it's inflation's a little bit of a mixed bag. But it's absolutely come down from where it was, and we're seeing less aggressive pricing. We're seeing more promotional strategies paying off on the consumer side, and so we're seeing a slight bit of give back on it. It's, as you're kind of alluding to, is this enough to really warrant we beat inflation, so it's finally time to cut rates? Let's go for it because inflation's finally dead. Maybe that seems aggressive. I'm old enough to remember when 2% was an actual goal, and now we've kind of not reached 2%. We're going to go ahead and do it anyway. But I'm a market beast. That's kind of where I make my money. And as far as the stocks are concerned, it's what they're expecting. Powell at this point, if he's not doing it in September, that's going to be a real problem because he more or less has promised it. So it's all about expectations, and it's all about kind of meeting that. As a market guy, I'm not crazy about that cycle starting, because that means it's the end of the anticipating, and all of a sudden the expectation goes from this fuzzy positive thing to, boy, eventually he's going to start raising again. And, we get to hear about that every month. So we're kind of in the sweet spot Goldilocks wise. Again, we've got a nice catalyst, fuzzy in the future. That's perfect. That's going to change. And that typically marks kind of the beginning, at least of the end of the beginning of the rally.
And what worries me really, Jeff, is once they start cutting, if they don't continue cutting, what will that signal to the market? Is the market going to get a little concerned if we get that 25 basis point cut in September and then not much else for a really long time? Once you set that expectation that you're laddering down, it's set, and the market.
Yeah. The second they start cutting, you start talking about when they're going to stop, when they start hiking again. And so then every data point changes, and the pressure changes, and we'll see how graceful that segue is on the market side of things. But as I said, typically that is at least the end of the beginning of the rally we've had, and stocks have been doing pretty well. And with every excuse in the world to fall apart. Remember the yen carry trade? That was the beginning of this month. Here we are at the end of August, and boy, no one gives a crap about that anymore. It's been a great August. So we'll see where we are in a month.
I'm surprised by an economy that's like an airline engine that you can throw geese at, you can throw anything you want at it, and it just keeps churning, just keeps going. Jeff, thank you so much for joining us on
Absolutely.
It's such a pleasure to speak with you. If we want to follow you, your thoughts, your thinking, where can we go?
You go to the Beats Roundtable, wallstreetbeats.com, and I'm on there a few days a week, and with some of the smartest guys on the street, guys and gals, and we're just kind of chewing it up and basically running our own money and telling people how we're doing it. Terrific.
And please stay tuned, because after the break, we're going to have another terrific conversation, this time with Sam Stovall. He's Chief Investing Strategist at CFRA Research, and we're going to want to talk in greater depth about NVIDIA, all the stock market moves of the day, the economy, and more. Stay tuned.
Sam's a sharp guy. Thanks, Janet. It's great talking to you.
Great talking to you.
Hi, everyone. I'm Veronica Dudo, and welcome to Buy,
Hold, Sell. If you have the Russians that are going into Ukraine, the Americans and the Germans and everyone else in Europe is going to say, hell no.
If Russia doing things, logically was their MO, I'd agree with you. Yeah, Todd, why don't you get him on a phone call right now? Hello, you.
And we're back here on the Money Path. I'm your host, Janet Alvarez, welcoming you back to our inaugural show today. And our second guest is someone you might already know well. It's Sam Stovall. He's Chief Investing Strategist at CFRA Research. Sam, welcome.
Hey, Janet. Nice to speak with you.
Absolutely. So, Sam, this is the market that just won't quit. I was joking earlier that you can throw anything you want at it, and it seems to continue on all cylinders. I do have one question, though. A month or so ago, we were seeing this rotation out of large caps into small and mid caps, and that seems to have somewhat been halted. What gives? What's going on?
Well, I think investors are still sort of in a wait and see attitude. What caused them to cool off on the small caps, in my opinion, was the worry that the Fed had waited too long, that the economy was slowing, and that there was an elevated risk of recession, because usually that's what ends up killing the mid and small cap stocks and causes investors to focus more on the large caps. I think it was also a combination of investors realizing, hey, the world is not coming to an end when it regards large cap issues in general and technology in particular. And so investors really, after the 8.5% decline through August 5th, because the world was not coming to an end, they essentially rotated from first to worst, meaning they moved out of the defensive groups that were holding up quite well during the decline and into the sectors that were beaten up the most, which basically were the high flyers of before, consumer discretionary, communication services, and tech. And until that re-rotation is finished, I think small caps will end up taking a back seat.
So let's talk about where small caps go from here, right? Because ostensibly, a rate cut should be good for small caps. It should lower their cost of capital. It should allow them to invest more in CapEx. But that doesn't happen immediately. That isn't an immediate catalyst.
That is correct. That historically what's happened is that small cap stocks, at least going back to 1989, when the Fed started telling us of Fed funds moves. Prior to that, they only told us about discount rate moves. But since Alan Greenspan and his more transparency, what's interesting is that in the period between the last rate hike and the first rate cut, large caps were up 16.5%. And small caps were up 10%. Not a surprise because investors worry about the potential of recession. Yet 6 months after the first rate cut, large caps were up 5.4%, small caps up only 1.6%. 12 months later, it's a similar kind of outperformance by large caps over small caps, with large caps up about 5% and small caps up around 3%. So I think it has more to do with the overpowering declines that we saw in 2001 following the first rate cut on January 3rd, and then also us entering into the financial crisis shortly after the first rate cut in 2007.
So as investors seek to rebalance or recalibrate their portfolios today, what is the right way to think about small caps and mid caps? Are they offering optionality? Are they offering opportunity? Or should we be taking a wait and see approach to see how the market overall reacts once we start receiving rate cuts?
I think that they're offering an awful lot of opportunity, because when you look at valuations for small caps, right now they're trading at a 7% discount to their own average 20-year PE on forward estimates, but a 31% discount relative to the S&P 500. And it's pretty similar to what is seen in the S&P Mid-Cap 400, a 28% relative PE discount. So these small and mid-cap stocks are definitely trading at very attractive relative PEs. So if you believe that the large caps are going to continue to do well and not fall into another correction, and you believe the earnings growth expectations, which for 2025, while up 14.5% for large caps, expected to show an 18% rise in earnings for mid caps and a 22% surge for small caps.
So let's talk a little bit about the underlying economy for a moment, because the Somme rule has been triggered in terms of recession expectations. But as our earlier guest Jeff Macke noted, it really doesn't seem like we're in a recession, at least anecdotally, when you go shopping at the Best Buys of the world or your favorite shopping destination. Um, on a comparative basis, I suppose we are seeing something of a slowdown. Of course, we're seeing an uptick in unemployment, but does this actually represent a normalization rather than a frank recession?
I think it's more of a normalization because I agree. I mean, now I have to make reservations for a Wednesday or a Thursday night out here in the boonies of Pennsylvania. I mean, so much so my zip code is EIEIO. So you basically do have to realize you're going to be competing with an awful lot of other consumers because the economy is strong. Second quarter, second revision was up to 3% from 2.8. Most people thought it would be stagnant at 2.8 or maybe even drop to 2.7, but no, we got an even better reading. We have strong readings or encouraging ones, at least in the ISM services, some of the retail sales numbers, et cetera. So unfortunately, a lot of the old tried and true recessionary indicators like inverted yield curve, leading economic indicator decline year on year, and other factors like that just really haven't worked. They'll claim credit for it, even if it occurs 3 years down the road because recessions have yet to be repealed. But I think because we are coming off of a unique situation with the pandemic, a lot of these old tried and true measures are giving false readings.
So many investors have enjoyed the fruits of fixed income and cash equivalents in recent years where they hadn't previously for many years because yields have been higher. That storyline might be changing soon. How are you advising investors? How are you encouraging investors to think about an environment in which the opportunity may not be as significant anymore in fixed income?
Well, certainly the Fed funds rate has not changed yet, so those people with cash in money markets are still doing fairly well. Those who hopefully had purchased some of the longer dated bonds a few months ago have benefited from the decline from the mid 4% now to the upper 3% area. But I guess it also depends on the investor. My father, who was an investor starting back in the early 1950s, essentially said, I never owned a bond. If I wanted income, I'd go for high quality, high yielding stocks because not only do they offer a nice dividend yield that's taxed at a more favorable rate, but they have the price appreciation potential. So, I would tend to say that look inwardly first. Clint Eastwood, playing Dirty Harry, always said a man's got to know his limitations. And so find out what your limitations are and invest accordingly.
And one of the sectors that's most likely to benefit from a decline in interest rates is, of course, housing. The housing sector, having been a little beat up, not too badly. I think we've all been surprised by the resilience there, too. What can we look for in housing stocks, and where can we search for opportunity in that sector amid declining rates?
Well, what is interesting is that looking at the first 30 days after the initial rate cut, going back to 1990, which is as far back as S&P has sector and sub-industry level data, home building was one of the worst performers, possibly because it's buy on rumors, sell on news, or at least take some profits on the news. But I think certainly this time around, you're going to be seeing investors who are optimistic that we will see additional people buying homes because now the mortgage rates are going to be coming down toward the rates that many of these prior home buyers have locked in and don't want to surrender. So I would tend to say that lower prices over the longer term would be very favorable for the home building stocks. I mean, we've got favorable recommendations on several within the group, like DR Horton, like Pulte, et cetera. And so, our belief is that they can benefit and see an improvement in their earnings.
The banking sector, too, especially small and regional banks, are going to enjoy the benefits of the decline in interest rates. I wonder, has the risk that we saw last year in that part of the banking sector largely evaporated at this point?
A lot of the risk, I believe, has, yes. I think now a lot of the opportunities are in those regionals and super regionals where they have been emerging from those depressed levels. Diversified banks have done very well over the last year or so, certainly led by the high quality JP Morgan Chase. But when you look to the super regionals, one of our strongest recommendations is on PNC Financial. So I think there are certainly other areas like East West Bank that we think could be good opportunities for the near and longer term.
And let's talk about the US dollar finally, because the US dollar, having seen a little weakness over the past month or so, really we've been seeing a volatility in currencies. Of course, the Japanese yen carry trade having been a big issue, a big catalyst for that sell off that we had a few weeks ago. Where does the US dollar stand now in relation to some of its major counterparts, like the yen, like the euro? And what sort of effect is that likely to have going into these changes that we're foreseeing in the coming months?
Well, we look at the dollar from an economic perspective against a basket of the Federal Reserve, looking at the whole world, and our expectation is that we're likely to continue to see some easing in the value of the dollar this year, and seeing about a 1.5% decline in the value in 2025. That would be good for those investors who have not given up on foreign stocks. A lot of the overseas markets have underperformed, just as small caps have here in the US. Small caps have underperformed the S&P 500 in 8 of the last 10 years, and you have a similar level of underperformance by international stocks. And right now, I mean, I was talking about very attractive relative PEs for mid and small caps. Well, you have similar kind of attractive valuations for the developed international and the emerging markets. And in many of the developed nations, you have more attractive dividend yields than you do here in the States. Of course, the demographics are not as good in many of these more developed countries, but still, for those people who do have exposure overseas, we're at least likely to see a tailwind come from the weakening of the dollar.
It's been such a pleasure to speak with you today. Thank you for joining us. Please tell us where we can get all of your thought leadership, your thinking, where we can follow you.
Well, first off, thank you for inviting me, Janet, and good luck with the show. People can find our research at CFRAResearch.com, where we offer regular wealth management research, technical analysis, as well as Washington political strategies.
That's Sam Stovall. Thank you so much for joining us today. And thank you for joining us today on our inaugural segment of The Money Path. It's a real honor, real pleasure to be here with all of you. We hope to provide you with all of the insights, all of the news, and some of the market-moving interviews that you're coming to expect. I'm your host, Janet Alvarez. We look forward to seeing you again.